The summer of 2026 brought a serious wave of anxiety to Wall Street. The S&P 500 was hovering near a record 7,800, pushing a widely watched valuation metric called the Shiller PE up to the 98.9th percentile of its entire history. The foundation holding up those record prices was surprisingly narrow. A staggering 47% of the entire index's value rested on the shoulders of information technology and communication stocks, driven almost entirely by the ongoing AI boom. Into this precarious environment stepped an indicator with an intentionally terrifying name. The Hindenburg Omen started flashing across trading desks. It triggered dozens of times. By mid-year, the Nasdaq Composite had tripped the signal 11 times in a single month, a frequency that had never been recorded before, and the S&P 500 recorded 13 triggers in a tight 3-month window. Financial media outlets quickly leaned into the name. They churned out headlines, warnings of an imminent crash, leaving everyday investors paralyzed by the idea that their retirement accounts were about to go up in flames. We need to look at the math to figure out if this indicator actually predicts disaster, or if it is simply a glitch in modern market architecture, driving a highly profitable media panic. Jim Mika, a self-taught blind former physics teacher, invented the Hindenburg Omen in 1995. Mika wanted a formula that could peer under the hood of a rising market to see if the internal engine was failing. He was looking for signs of fragmentation that the top-line index numbers were hiding. This chart shows breadth divergence. The Omen triggers when many stocks hit 52-week highs, while an equally large cluster hits new lows simultaneously. While stocks usually move together, this extreme split reveals deep internal indecision. The market is pulling itself apart. The Hindenburg Omen is a clinical measurement of market fragmentation designed by a complete outsider. This fear comes from a real place. The signal flashed before the 1987 Black Monday crash, the 2000 dot-com peak, and the 2008 collapse. The Hindenburg Omen has a massive false positive rate of 75%. 3 out of 4 times it rings the alarm, no crash materializes. Furthermore, since 1970, average S&P 500 returns in the months following a signal are actually robust, going up more often than down. A major reason for all these false alarms is a structural flaw in how the New York Stock Exchange operates today. When Jim Mika built the formula, he was tracking individual companies, but today the exchange is packed with exchange-traded funds and bond tracking instruments. When interest rates shift, hundreds of these bond funds can hit 52-week lows all at once. Meanwhile, operating businesses are still hitting new highs, artificially triggering the Omen's math, even though the actual stock market is perfectly healthy. Those terrifying clusters of signals in the summer of 2026 were heavily polluted by this exact data problem. Investors were panicking over a legacy formula that misreads the modern architecture of the stock market. Market experts like Tom McClellan advise treating the Omen as a tornado siren. It is a warning to check your surroundings and review your risk, not a guarantee that a storm is headed directly for your house. The real danger lies in the behavioral trap of market timing. Historically, exiting the market based on a scary technical signal usually costs investors far more money than riding through an actual downturn. This comparative bar chart shows exactly how devastating that trap is. If you stayed fully invested in the S&P 500 over a 30-year period ending in 2025, you averaged an 8.4% annual return. But if you pulled your money out and missed just the 30 best trading days over those 3 decades, your return collapsed to 2.1%, failing to even beat inflation. The stock market has a cruel tendency to pack its highest returning days into the middle of a bear market or the immediate aftermath of a sharp panic decline. If you sell out to avoid the pain, you guarantee you will miss the recovery. The smartest response to the 2026 Omen clusters is a calm portfolio checkup. Instead of moving to cash, use the warning to rebalance your holdings, trimming down heavily concentrated tech positions and diversifying your exposure. The most successful investors tune out the apocalyptic media headlines. They trust the long-term math, maintain their discipline, and prepare their portfolios so they never have to panic.